from Allianz Global Investors, and I'm very pleased to be here. Thank you to BBLAM for inviting us to speak about China. So I know there's been a lot of reference to China this morning, and if there's anything to demystify for this year, I think probably China should be top of the list. So hopefully in the next 30 minutes or so, we can talk about what's going on in China, and in fact, what are the key things to watch, and also what are the opportunities in the China market. So, of course, China's been a tricky place. We've been through some hard yards over the last 2 to 3 years. We know investors are sitting on large losses. There's been a lot of disappointments and false starts in the China market, but we do see some signs that things are starting to change. We're seeing a stabilization in some of the economic data. We think there's a bottoming out, if you will, of some of the macro noise that's been hanging over the market. And most importantly, we don't think the China growth story is over. So the title of this presentation is Profiling the Opportunities. We do think there are opportunities in China, but you need to be selective. So let's take a look. We all have seen the headlines that have been involving the China market with regards first and foremost to the COVID policies, then the property sector as well has seen declining property prices, large-scale, high-profile developer defaults, whether it's been geopolitical chip wars or shadow banking. There's been a lot of negatives out there. These are well known, but there's also been some good news too. China set out this year to have a 5% GDP growth target. I think most market observers thought this was sort of a low bar, but you know what? China's well on its way to achieving that target for this year. So that has not been too aggressive, and we've seen a lot of stimulus across the market in terms of financial reforms, in terms of support for the ailing property sector, and also on the geopolitical front. In fact, there have been a number of new initiatives just this year. For example, China is re-engaging with diplomatic and business leaders from around the world. Later this month, Xi Jinping is proposing to meet with Joe Biden in November. So, dialogue is happening on the world stage, and China is a part of it, and we think those are really encouraging signs. No one's giving the market any credit for these developments, but they are happening, in the backdrop. In fact, there have been over 200 policy support measures introduced to stimulate the Chinese economy, but it just doesn't seem to be enough to get markets really excited and to rekindle those animal spirits. But little by little, we think we are moving in the right direction. And the last thing I wanted to mention is more on the theme of common prosperity and with regards to private enterprise. We've seen some relaxation of the crackdown on the internet and e-commerce sector, for example. There's been a lot of regulation around that area, in addition to healthcare, in addition to P2P lending, online education. Many sectors have been sort of through the grills with Chinese regulators, and we're coming out on the other side. So all of that seems to present a big dilemma for investors. What do we do with China? If we look on the right-hand side of this chart, you can see the blue line is the onshore market, the stocks listed in mainland China. The green line is predominantly stocks that are listed offshore in Hong Kong predominantly. And you can see the pain path that we've been on. The markets have not been working. Chinese equities have not been working. However, we think that the government does have the policy tools to right the situation, to get us through this cyclical downturn, and to have a more sustainable recovery path going forward. The key question is really about getting confidence back into the local market. We need to see the local market pick up. We need to see more local investors buying Chinese equities before the foreign money will come in. And typically that's how it works. The local money jumps first and foreign money piles in after that. The problems underscoring China are clearly related to the property sector, to local government financing vehicles, and to the enormous debt that we keep reading about. Clearly, the government is keeping a very, very close watch on this area of the economy. The property sector, both directly, so the construction developers themselves, in addition to indirectly, whether it's through home appliances or construction equipment, scaffolding, weatherproofing materials, the whole chain of property represents around 25% of China's GDP. So it's a really big deal. And what we've been seeing is a lot of stimulus to support the consumer, to get the homes built that people paid for. And I think that's a very important differentiation. These are homes that people have paid for. It's not like the consumers have overextended or don't have access to credit. Mortgage rates in China are very low, in fact, the lowest in history. So housing, it's not a matter of affordability. It's really a matter of getting the homes built and the completions going again. And that's what all of the relaxation tools that have been implemented are designed to do, is to kickstart those completions. But we don't see another crash in the property market. We've already had that. Things have gotten pretty bad, but we do know that the situation has its thorns, and it will take a while to resolve. We're talking years. Okay, it's not going to go away overnight. The question that we're getting asked more and more is China investable? Right? Do we even need to be in China? And our answer is yes. And here's a few data points to back that up. We think China is an asset class. There are more than 6,600 stocks listed in China. If you look at the Shanghai, Shenzhen, Hong Kong exchanges, and also the Chinese stocks that have listed overseas in the United States. So that is well above almost 1,800 stocks more than the Euro area, for example. It's a very large market. It's a very diverse market, and there's a lot of interesting and best-in-class companies in that market that you don't want to miss. These are companies that will make money over time, irrespective of how the broad market does. So yes, we do think China is investable, and we think it's an important asset class within a portfolio. The reason why China is an important investment is because it is a great diversifier. Regardless of the timing, is now a good time, a bad time to be in China? It's always a good time to be in China from a portfolio perspective, because the correlations between China and other equity asset classes are very low. So the way to read this particular chart, if you look across the top row, China A shares, these are the correlations of A shares with other equity asset classes. So Japan equities, 0.24, US equities, 0.26, world equities, 0.29. What this means is that more than 70% of the time, your Chinese A share equities are moving in an opposite direction as your MSCI World equities. It is a different animal. China behaves very differently to other asset classes. So that, from our vantage point in a portfolio context, when you look at all your options out there where to invest, China is a good diversifier. In terms of valuations, other speakers today have mentioned that Asian equities are cheap. China is a cheap market. This chart here is showing you the valuation by sector, and this is a 15-year data series. And the current valuation is the gold diamond. And you can see that any time that gold diamond is below the break in the bar, that means it's below average, it's cheap. And you can see pretty much every sector: healthcare, IT, communication services, industrials, energy, financials. There is value to be had all over the China market. And so, you know, typically when you buy Chinese equities, going back to the buy low, sell high, typically when you buy equities at low entry points, you tend to get a pretty good return. So it's, you know, next to impossible to call the bottom in a market precisely, but what we can say is that the risk reward does seem to be tilted in our favor with valuations that look like this pretty much across the board in the domestic China market. So China has effectively two big things that they need to deal with. We're calling this a strategic crossroads, and for simplicity's sake, we've broken it into two categories. The first we're calling contain and consolidate. This is with regards to those legacy issues, all the bad stuff that everybody knows about, property, debt. Put this to the side. Develop a framework of transparent and constructive framework that this needs to happen at the central government level to deal with the problems and unwind this debt and develop a more sustainable path going forward. This needs to happen in the background. However, as investors, for our portfolios, we're focused on the right side of this page, the promote and grow. We need to find areas where China can really make a difference in the world, where China can develop innovative and modern technologies that can lead China to the next stage in its development and growth. And some of these areas are in, for example, manufacturing upgrade. This is a big emphasis in our portfolio, things like robotics, automation, anything that can improve the productivity in China, because as we know, there's a large population, but it's an aging demographic, and they need to enhance productivity through more modern and self-sufficient ways. The other area is services. The services and private sector need to kick in. It can't just be the government doing all the heavy lifting. We need to see private enterprise playing a bigger role in the recovery path, and we call this promote and grow. We talk a lot at AGI about innovation and technology. We're growth-oriented investors, but I think technology sometimes as a term is misunderstood. When we talk about innovative technologies, we're not just talking about the tech sector. There's a whole ecosystem that underpins what's going on in technological innovation, particularly in China. And it can be artificial intelligence, advanced manufacturing, I just mentioned robotics, big data, semiconductors, renewables and green tech, new energy vehicles, software, internet. All of these are areas that are represented in our portfolios and where we think China can really move the needle and has some best-in-class businesses. And we know this because if you look on the left-hand side, you can see the R&D expenditure on growth in China in red. The slope of that line is the highest in the world. This is very much a commitment in China to becoming more self-sufficient, to developing its own technological capabilities, largely for reasons of national security, but because China can no longer rely on other countries for its technologies and needs, instead of being so much of an imitator of those proven technologies, it needs to be a true innovator. And China's innovation has been going on for a long, long time. In fact, China is already the world leader in a number of categories. It's the more autonomous driving tests are conducted in China than anywhere else in the world. My colleagues go to China and ride in driverless cars as taxis regularly. China dominates the world in solar panel productions and the solar supply chain. China is well on the path to 6G technology by 2025. There are over 1,000 new drugs under development in China. Many of these drugs are in partnership with large European and American pharmaceutical companies, and it's the world's largest market for industrial robots. So China already has a very strong footprint in innovation and needs to carry on with these initiatives as part of its future growth plan. We've heard about the youth unemployment situation in China. I did want to address that today because that is, I think, a pretty important issue. The issue with youth unemployment is China has a very large population. It has a very well-educated population. The number is, in fact, staggering. There are 10 million university graduates every year in China. 10 million. You know, very smart, bright, capable people. And that, you know, they're selective in the types of jobs that they want to do. And this goes back to my point about the private sector and about the services economy. These areas really need to do the heavy lifting and create jobs for young people that want to do innovative things, that don't want a government job, don't want to drive a taxi, that don't want to wait tables. They want to have a professional career, and they want to have hope in their future. And so we think that there are really exciting opportunities for private companies to fill that gap and to create job opportunities for young people. You know, with what's happened in the internet sector with Common Prosperity, we've seen entrepreneurship in China has been somewhat subdued throughout the last, 3 years or so, but, we need to see signs of that coming back, and that's what, as investors, that's the kind of thing that we're really looking for to really, spark the market and be a catalyst. I've talked a little bit about new energy vehicles. We think EV is a very, very important category. China already is very dominant in this space. 1 in 5 cars in China sold is an electric at this point in time. And what China does well is they make EV cars across the spectrum at all different price points, with all different sort of functionalities. So for someone that wants an entry-level car that maybe doesn't, takes longer to charge or doesn't go as far, there's a car for you. If someone wants a luxury car that's, branded, there's a car for you. If you're more mid-range, mid price point. So China offers all of that. But it's not so much about the cars themselves or the OEMs, the car manufacturers, but the whole value chain behind the electric car or an autonomous driving car, whether it's the battery materials, the separators, the braking and safety systems, smart cockpits, the thermal management of heating and cooling temperatures. All of these parts are interesting investment ideas to us, and these parts and components are all coming from China. So this is a big part of our investment portfolio. The sector's been somewhat depressed. In fact, the whole renewable sector in China had a big sell-off when growth came off so heavily. But we think we've seen a real bottoming out and are quite excited about the new energy vehicle space in our portfolio. Another area that I wanted to bring up is the rise of domestic brands. And we've already seen this in the morning with regards to what's going on in Vietnam. And the exact same trend is happening in China. We are seeing a preference where local people in China, people who have the means to buy whatever brands they want, are choosing domestic Chinese brands. And we've seen it in clothing and in sportswear. We've seen it in automobiles. This particular example is cosmetics. We own a Chinese skincare and cosmetics company in the portfolio that we think is the leader in this category and is taking share from Japanese and Korean brands because the products are very good quality. Consumers like them, the marketing is very savvy, and the price point is better. There's also some sort of national pride in buying companies that are homegrown. So we think this local champion brands is a very important component of the China growth story. There's been considerable discussion and coverage of weak consumption in China with the reopening post-COVID. The uptick in consumption has been somewhat muted. The while people have gone out and are spending, the dollar value that they're actually spending is lower. So they've traded down. They've learned to live with less during the COVID period. They want to be more conservative with their finances, and so they're buying products at a cheaper price point. And so some of these Chinese brands play right into that sort of the consumer mentality or consumer psychology. So while we like these companies and we think they can be local champions, there's no reason why these companies can't become global champions down the road too. As more and more adoption comes out, as more and more people get familiar with these brands, there's no reason to think that they won't be on the shelves here in Thailand and Singapore, even in Europe and elsewhere. So that's a really exciting area for us as well, despite the challenges in the consumer space. I will mention that the China market is very large. It's very pragmatic. There are different provinces that have different tastes and so forth. We have what we call grassroots research, which is boots on the ground. These are investigative journalists that will do focus groups and surveys of consumers to understand what preferences of the buyers are, what brands are selling, what people like, what people don't like, and that really does inform our investment decisions by giving us some local knowledge that we think is a differentiator, especially in China because it is such a complex and somewhat dispersed market. And then the last example I wanted to share is with regards to AI, artificial intelligence. This category has gained a lot of popularity in the last year after the OpenAI ChatGPT was released. China has the equivalent of ChatGPT. China is in fact very, very advanced on the AI spectrum and is moving very quickly in this regards. In our portfolio, we are playing AI. We think this is a structural trend and that it is indeed a game changer. Some of the ways we get AI exposure in China is through networking switches that are used in data centers and cloud computing. We own the largest office software company in China that's using generative AI in some of its applications. And then we also own a temperature cooling company because, as you know, the more advanced the chips are, the more heat that they give off. And so you need to manage the temperature and make sure that they don't overheat. So those are some examples in the portfolio that, despite what we hear, all the bad news, all the stuff related to property and so forth, there is a lot of neat and innovative opportunities for investment and ways to make money that we think we can find in China. These are the broad themes and trends where we have exposure in the portfolio. I've touched on some of these. The first is self-sufficiency. A lot of this is obviously related to technology and semiconductors in particular, where China and the U.S. are in a race, against each other. Who's going to be the tech powerhouse? And China has surprised many, in fact, with its capabilities in semiconductor development, even despite the sanctions and the export bans that have been introduced. China is still well on its way to building technology expertise. Same thing with AI I mentioned, but it's also in other areas like food security. China needs its own food supply. It needs its own energy supply. These are areas of interest for our fund managers. Innovation-enabled upgrade, of course, big data, AI, digitalization. We need more modern, more self-sufficient manufacturing in China, and this is clearly a big emphasis. Many of these names fall into the industrials category or the industrial sector. Domestic consumption, of course, the domestic brands we're seeing across the board, not only in cosmetics, but in other areas as well, food, clothing, et cetera. Financial market reform. I haven't talked about this one, but actually there's been quite a few developments in China just this year to open up China's capital markets to foreign investors. The way that we access Chinese equities as foreigners sitting outside of mainland China is through the Stock Connect scheme. And just this year, more than 1,000 new stocks, predominantly small and mid-cap companies, have been added to the Stock Connect scheme. So that's 1,000 new stocks that we can buy through this platform, ourselves and others, of course. So that's a pretty interesting development. It didn't get a lot of fanfare in the press, but this is important in our view. They've also made it much easier for Chinese companies to IPO in China. In the past, many sort of innovative internet, new economy stocks would go to New York to list in New York, and because the process in China was so onerous, but a lot of that has changed now. So we do expect to see more IPOs in China as the market recovers, more M&A, more transactions. So this financial market reform is very, very interesting. And then last on the list is green tech and renewables. China has very ambitious decarbonization, net zero goals, and has put a lot of money into things like solar and wind power, hydropower, EV, et cetera. This area in China is very crowded. There are a lot of players in the market. It's very competitive. In some areas, the margins are very, very thin. We've lightened our position in the renewables sectors in general, but we do think long-term, this is an important growth area that clearly the government is well supportive of in China. So we need to, pay attention to the renewables area. So in summary, just wanted to close with three key things. The incremental policy support is starting to work. It's not going to be a huge V-shaped recovery. We're not going to have launch off from where we are now, but we think things are indeed stabilizing, and that the valuations look very attractive after the cyclical downturn that we've been through. We know that China is a maturing economy, so it faces the challenges of slowing growth, but more stable and structural growth. And we think innovation-led companies are the best way to play the next round of China, if you will. And finally, we're focusing on a diverse group of companies that are best in class, blue chip businesses, but that are focused on areas that are aligned with the government, aligned with the consumer. And these are advanced manufacturing, artificial intelligence, new energy vehicles, green tech, and also the rise of local brands. So with that, I hope you feel a little bit more confident in China, maybe not as many questions, and fingers crossed for the rest of the year and into 2024. So thank you for your time.